Hey guys, what is happening and welcome to today's video. So in today's video we are discussing this Financial Post article. It's incredibly important, I believe, because all these things that we often talk about on this channel are now coming out into the mainstream. So anyway guys, if you haven't done so already, please hit that like button. It's freezing out here, it's like -10. Please subscribe to the channel. If you haven't done so already, then sign up to the email list below. That's available until we hit 1,000 subscribers, guys. So anyway, guys, let's get into it. Let's do this. All right, guys, welcome back. So let's dig straight into this. Low interest rate loving Canadians have lapped up $193 billion in new mortgage debt during the pandemic, taking total household debt to a record $2.5 trillion. That is insane, guys. That is so much money. You have to put that into perspective of the economy to really realize how much money that is. I know a lot of these days we are brainwashed and kind of numb to the fact that government is spending all this money and this is happening and consumers are spending all this money on debt. We don't really put this stuff into perspective. So I urge you, go look at that, because that's when you'll realize, hey, this number is a hell of a lot of money for Canada. But the party is about to end as central banks look to take away the punch bowl. The US Federal Reserve and Bank of Canada have both signaled a faster return to monetary tightening next year as they pull the interest rate levers to tame inflation. Now, yes, we know they're doing this. This has been in the news, obviously. They just keep upping their timelines of when they're going to tighten, and Canada has already got rid of the QE now. And quite frankly, it's worrying to see what's going on in the bond market. Really tells us a story of what might be happening in 2022, which isn't good, guys. And there's a lot of different indicators like the euro dollar futures, and there's a link below if you want to learn more about that. That's a very good indicator of future recessions, and the yield curve is inverting. So that's not a good sign, guys. Our analysis suggests households are well positioned for the gradual rise in interest rates that we anticipate in the coming years. However, if rates were to rise sooner, more rapidly, higher debt service costs could materially constrain consumption, causing a broader slowdown in the economy. I talk about this a lot. When people spend a lot on housing, it's not really that productive. You know, there can be ways it can be productive, but mostly people are buying it for shelter. You know, we like to talk about foreign investors and house flippers and all those different things. But we always forget that most people who are buying are still people who are buying to live in that house. Now, that is the fact of the matter. Yes, there are all these other variables, but when you buy a house to live in it, after you've bought that house, if it's very expensive, that means your spending is going to be less. You're going to be house poor. That money's not going into the economy, so that causes economic slowdowns. So the thing is, it's not a case of if the economy is going to slow down, it's a case of when, and that's already started. And it had already started prior to the cerveza sickness, guys. The Canadian economy was slowing down because it was under a mountain of debt. And that mountain has just got even bigger, meaning the downside risks are even greater. Mortgage debt now accounts for 68.7% of total Canadian household debt, compared to 65.9% at the end of 2019. Yeah, not much to say on that. It's just ever increasing. Another red flag, low quality mortgages now make up a quarter of all mortgages compared to 14% in 2019, underscoring the vulnerability of some households to higher rates. Just put that into percentage terms, the increase from 14% to 25%. That is a hell of a lot of an increase, guys, and this is low quality mortgages. And we've been talking about this on this channel, you know, fraud, mortgage fraud, and all these subprime HELOC mortgages that are actually AAA rated. It's all gonna come and bite us eventually. People just don't believe, and it really winds me up, people just don't believe that this is going to end. They just think it's going to carry on forever. And I would just say there's only one bubble. according to the BIS anyway, that is bigger than Canada. And I'm talking about a credit bubble here, not a housing bubble. And that's China. And look what's going on in China right now. And that has happened because they've tried to tighten monetary policy. And the thing is, once you trigger this off, you won't be able to stop it. So don't kid yourself in thinking that they're going to come out and be able to bail this out, because once it starts, it will not stop, guys. Other issues in Canada's housing market are all emerging, with the Bank of Canada blaming investors for frenzied market activity in the real estate market and the federal government looking to squeeze out the house flippers. Yes, now obviously we know that this is the case, that they don't like house flippers. You know, there's two kinds. If you're actually adding value, renovating, then you're doing a service, really. So I don't think that's a bad type of flipping. I mean, that's a legitimate business. But if you're just buying something, holding it for a couple of months, hoping it will appreciate, which is what a lot of hedge funds do, and mom and pop investors, or investors with quotation marks, I would say. But the thing is, all this does is distort prices even more. When this happens, it just makes those price increases even higher, and it just distorts the picture altogether. I mean, if we take Calgary for an example, because there's not really many speculators here in Calgary, and the pure and simple reason for that is there is just so much building here, way more than the city needs. So the fact is, if you're a speculator, you could never keep up with that. With speculative buying likely set to stagnate or fall as the Bank of Canada embarks on a rate hike cycle over the coming quarters, the hot Canadian housing market could be in for some trouble. Though an important caveat here is that the demand could be buoyed by the expected immigration influx as the reopening phase continues. So we know this whole immigration narrative is a load of BS. We've covered it many times, and there's actually a video that I'll put in description. It's very long, it's about an hour long, but trust me, you're gonna wanna go and watch it, because this whole immigration narrative is just a load of BS. So every time you hear that, just think BS, because that kind of reminds me of what the government always says. And even those numbers of like 400,000 people come in a year, they're not correct. And just look at the population, guys. I did this for a viewer who was commenting the other day. I looked at the population growth, I think, between 1960 and 1980 or 90, and then 1980 to 2020 or whatever, something like that. Anyway, the population growth was way bigger during the 1960s, 70s and 80s than it is now. And that's what people don't get. The population has grown. So those numbers are actually kind of misleading, because the thing is, it was growing faster back in the 1970s and 80s and whatever, and the real estate market crashed in the late 80s. So the thing is, just saying it's immigration is absolutely insane, and housing prices were flat in Canada throughout that entire period, and we are building way more. So to say that immigration is causing this is just ludicrous. More Canadian households are expected to be sensitive to interest rate movements, as a quarter of outstanding mortgages by September 2021 were on a variable rate, up from 18% in February 2020. Yeah, so we need a whole video to talk about how bad that is. There's two types of variable rates, and one of them in particular, the fixed variable rate mortgages, are absolutely terrible. And a lot of people with those mortgages won't have realized that just by buying a home and getting one of those mortgages, they could lose it as well. The share of new mortgages with a loan to income ratio of above 450% jumped to 22% in late 2020, led by an increase in highly leveraged uninsured mortgages. This is well above the recent peaks in 2016 and 2017, and more recent data from the Bank of Canada suggests this share rose further to 25% in early 2021. So that just kind of tells you the picture. And we've talked about this before. Again, loan to value ratios, they've gone through the roof. Well, it's obvious why. When people are using home equity lines of credit to fund a down payment, these just go out the window. And the thing is, the increase in uninsured is not a surprise anyway, because most of these people who are highly leveraged, they use debt to fund the down payment to 20%, and then they go out and buy the house. They don't even realize how each house is stacked on each other, and it's just terrible, guys. But anyway, guys, I hope you enjoyed this video. If you did, please hit the like button. Please subscribe to the channel. And anyway, guys, I will see you in the next video. As always, peace and love. Bye-bye.